Good morning, everyone. I'll start with a short story, very short, and then create a framework to share. But when I was in kindergarten, I was expelled from kindergarten for being a superhero. And I didn't think much about this, but it was a defining experience because my parents took my side for a lot of different reasons. But then I was reading the front page of the Stanford magazine, and I saw this really interesting research on black boys being expelled at 4 times the rate of their white counterparts for the exact same infraction. So this was written by a psychologist at Stanford. And I thought to myself, well, it was an all-white kindergarten class except for me, so maybe there was something in this. So I called this person and sat down to lunch with Dr. Jennifer Eberhardt, who's one of the world's leader in an area called implicit bias. And basically came up with, we understood the psychology of what she was talking about, which is that she basically found that on the first infraction, the black student and the white student were treated the same. On the second one, the black student was labeled a troublemaker, and while the white student's actions continued to be thought of as an infraction. And part of what I discovered in that process is the same thing that leads one of the big factors of the achievement gap in education, of which I invest a lot in, education technology, is one of the same things, if applied to finance, would be called an arbitrage gap. So looking at the ability and the psychology of people to miss opportunities and applying that in a financial framework could lead to some really interesting, undervalued areas to invest in the economy. And lo and behold, after 7 years of leading private equity at Calvert Funds and investing in 16 funds around the world, what I found is funds like you'll hear from Nancy Fund a little bit later on this afternoon had not only achieved tremendous performance, but had done it by investing in 3 or 4 times the amount of women entrepreneurs. And if you talk to Nancy, like you will later today, one of the things that was powerful is she's looking for the best entrepreneurs. And she's finding the best entrepreneurs, yet many people, which is why she's 3 times or more above the average of investing in women-led companies, can't see what she sees. So what I've found is that there's a really interesting area that I decided to build a private equity fund of funds to focus on, to invest in the top performing impact fund managers in the world and work with Dr. Jennifer Eberhardt to create interventions to help them to see opportunities that they're missing, which is the heart of the thesis around Illumen Capital. But one of the other things that was missing in terms of the overall sector of impact investing was also the connection of entrepreneurs to the communities in which they're trying to transform and create solutions for, what Brian Stevens would call proximity. So the idea that people that are investing large amounts of money to transform the world would sit down with the communities that they're trying to transform is really a second really important pillar of what we're trying to accomplish. The final thing that I would just share in terms of the framework is that impact investing struggles with as a sector that I've seen over the time that I've spent at Calvert is that exits, and this will be familiar to some people, but if you spend all this time growing a company from 5 million to 100 million or 200 million and selling it, then one of the challenges that you face is how do you lock in impact at exit? And part of the research that the fund is undertaking is not only with the Stanford School of Psychology by sponsoring research there, but also looking at the Rock Center at Stanford where it focuses on corporate governance. And we'll study the Ben & Jerry's sales agreement, which is a board that I sit on, that was created inside of Unilever to protect the social mission of the company across 92 legally binding provisions. So by making that public and studying the impact and the influence that the sale of Ben & Jerry's has had on Unilever, which is really the heart of the research, because if we can sell companies that impact $60 billion companies and change the needle just a little bit, 10%, then we're creating a $6 billion impact by selling a $200 million company. So that's in terms of the struggle with the language of impact and redefining the language of impact. I think that's one of the big challenges that Raul presented us with, that if we don't get right, so my big fear, to close my remarks, is that the $59 trillion that Goldman Sachs has identified as shifting generations shifts generations before we get the language right. And if we don't include, so right now, also in terms of numbers, $31 trillion in U.S. asset managers, 1% is managed by firms owned by women and minorities. So huge problem. Now, if impact investing doesn't include that in the vernacular of what we're discussing and moving the needle on that particular area, I think we've missed a huge opportunity as the flow of capital moves. So next generation inheritors will spend money and make investments more aligned with impact, but the question is, what will that impact in terms of the language include, and what will it exclude? Will it reinforce the same biases in the predominant global financial markets, or will it help to change and transform that? Thanks.